If you're a real estate investor or a real estate investment professional and you can't seem to find a straight answer to what the difference is between a core plus real estate investment deal and a value add real estate investment deal, make sure to stick around because that's exactly what we're going to break down in today's video. For first dibs on all new real estate financial modeling and career training videos, make sure to subscribe to this channel and hit that notification bell to be notified every time I release a new video. Now, if you've heard the term value add or core plus in real estate investing in the past, but you can't seem to find a straight answer to exactly which deals fit in each bucket, by the end of this video, you'll know exactly which deals fit in each category and how you can use this to make smarter real estate investment decisions on your next deal. So this is one of the most common questions I get from my students in my courses, and it makes sense. Most definitions of these two categories are ambiguous and actually really confusing. So to make this clearer, let's actually start by defining what these terms actually are. So the terms value add and core plus are terms that are often referred to as capital risk buckets. And with each bucket, investors are taking on a different level of risk, and because of that, those investors also expect a different level of return. Now, generally how this works is the higher level of risk, the higher the expected return by that investor, and the lower the level of risk, the lower the expected return by that investor. So as we move through this video, keep that in mind, that risk and return are the biggest determinants of which bucket you're going to put each deal. So let's start with a core plus deal. So what is a core plus deal in real estate? Well, a core plus real estate deal is a deal that will generate leverage returns, which means debt is used that generally fall in the 9% to 12% range on an annualized basis, or really that internal rate of return metric. Now, in most cases, this would represent a real estate deal with a little bit of upside, but not a major renovation or leasing component. For example, this might be a shopping center at 90% occupancy with stable tenants in a secondary market with some immediate leasing upside, but not a ton of upside in the deal. Now that said, there are some simple levers that you can pull in order to increase net operating income without a ton of risk on the deal. So to really break it down, core plus is lower risk and lower returns, but there is some upside on the deal, but not a ton of risk associated with actually executing on that upside. So now that we've gone over a core plus deal, what is a value add deal? So a value add deal is a real estate deal that will generate leverage returns, so again, using debt, usually between 13 and 16% on an annualized basis, so again, that IRR number. Now, in most cases here, this is a deal with a lot of upside, either through a renovation or improvements in operations at that deal. So an example of this could be an apartment building built in 1985 with units in original condition, and with a renovation of unit interiors, the property could increase net operating income significantly. However, to do this, the investor will have significantly more risk of loss if things don't go as planned. So if the cost is higher than expected, or the investor can't actually achieve the post-renovation rents that they had underwritten on the deal when they first bought the property. That said, there is also significantly higher reward if things do go right, and returns will likely be higher on the deal. Now, the questions here really come from situations where a property might not clearly fit into each of those categories. So how do you actually put a deal into a capital bucket if it's not actually clear which capital bucket it belongs in? Well, like we talked about earlier on in this video, the bottom line here is the return profile of the deal. So if a deal has a major renovation component, but you're also projecting 9 to 12% levered returns, that deal would fall into that core plus category. Same thing with value add deals. They don't necessarily need to be a major rehab to hit 16% returns. So if the actual operation and business plan feels like a core plus business plan, but you're going to achieve a 15 or 16% internal rate of return, and that's what you're underwriting to, that deal really belongs in the value add bucket. So if you find yourself unsure of which bucket a certain deal should fit in, ask yourself what kind of returns would you need to achieve on this deal in order for it to make sense for you to invest in. So there you have it. That's how you can categorize deals between core plus and value add real estate investments. Now, if you're looking to break into the real estate investment industry for the first time, or you're looking to advance your existing real estate investment career, the most important skill set that you can learn is real estate financial modeling. So I've taught over 10,000 students real estate financial modeling through my online courses. And what I've done for YouTube viewers is actually put together a free 3-part real estate financial modeling crash course. And you can grab that again for free in the link in the description below. So if you're looking to advance your existing real estate investment career, or you're looking to break into the industry for the first time, I'd highly recommend checking out that class. Now, if you like this video, make sure to let me know by hitting that like button, subscribing to the channel, and sharing it with anyone else who might find this helpful. Thanks so much for watching, and I hope to see you in the next video.